Nvidia continues to be the poster child of the AI stock revolution, even briefly surpassing Microsoft as the world's most valuable company, but the warning signs have been quietly stacking up for a while now. Barron's just reported that analysts are questioning whether Nvidia's valuation truly reflects its long-term prospects. In this video, we're going to dive into what some experts believe way too many investors are missing about Nvidia in 2025 and show you how you can get ahead of the crowd on this one. Now, this is a MarketWatch article by Jefferies Analysts suggesting that Nvidia's earnings call addressed key concerns, yet valuation questions persist. Guys, on this channel, we've been talking about this. We talk about valuation. We say, listen, Nvidia is an incredible company, incredible balance sheet. Everything is going for them. But the fifth and most important pillar in our principle-driven investing is a great story at the wrong price can become a bad investment. That is very, very key. If you don't understand that, then you're probably going to make a lot more mistakes in investing. Yes, you'll catch the hype as it's going up, but you've got to remember, as that hype goes up and up and up, and people don't pay attention to fundamentals, you might be paying too much for a great story, and that leads to a bad investment. So here, the biggest issue for Nvidia stock was not China, according to Jefferies, but rather the disconnect between their Blackwell sales and the GB200 shipments. Guys, at the end of the day, I hear this and I kind of chuckle. I look at it going, why are we being so specific about GB200 and Blackwell? You know, we sit there and say, a company is going to have its issues. Any given day, a company as big as Nvidia is going to have a lot of issues. They're also going to have a lot of good things. The question becomes valuations. You've got to have that margin of safety because you can't possibly be an investor who understands every single sale, every single item, what's their inventory, what's their turn time, et cetera, et cetera. I mean, you might want to do that, but God, that's a lot of work.
There's probably people in upper management that don't understand that have been there for 25 years.
1,000%.
Yeah.
They probably don't pay attention to these things.
Right.
And we tell people, guys, this is why we preach margin of safety. If you have an ample margin of safety, you can sit there and say, listen, I don't know everything about this, but I know enough to say, hey, if the valuation makes sense, if this is still a growing company. Let me ask this question. In the next 10 or 20 years, do you think Nvidia will have more revenue, more profit, or less revenue and less profit? Mo, what do you think?
I would say more, but it's spiked so much in the past several years that I might go, maybe not.
What about 20 years from now?
Probably.
Okay, and exactly, and here's why. So let's look at it this way. Let's pull up Microsoft. Microsoft, actually, you know what? No, let's not do that. Let's pull up Intel.
Okay, this is a good example.
Intel is the darling
it's a good
of the
comparison.
2000 tech bubble, and it has absolutely struggled as of late.
Yeah.
Right? But here's the interesting part. Let's go to their financials. Let's pull up 1999. In 1999, they did $29 billion in revenue. Guys, in the last 12 months, they did $53 billion, and that's not even their peak. Their peak was close to $80 billion. That's what's incredible here. Still, not even doing well, it still has more revenue.
Yeah.
Profit? Probably the profit's gonna be a lot different because of negative write-offs here, but $7.3 billion in 1999, is that the correct number? No, sorry, yeah, $7.3 billion. And in their years recent, before their kind of downfall, they were at $20 billion. Mm-hmm. So even when the stock, but guess where the stock was? When they were here at the 20 billion number, they were at like $60 a share.
Yeah, I think that was their peak. It was like 60 on the nose.
That's our point here. So I would have sat there and said, listen, if I ask the same questions 20 years from now, 25 years from now, will Intel have more revenue and profit than it does today? The answer was yes. But why is the stock down? Well, the stock was down because this was absurd. This market cap, this valuation was insane.
Go ahead, you have to understand, this was the hype. This was it. Intel was the Nvidia, the Tesla. This was the stock.
And a lot of people watching our videos, even if you're 45 or 50, you don't. I don't know if you're necessarily paying attention at the age of 20 or 25.
Right.
But let me put it this way: if you watch TV, people were bringing up Intel into shows. Like, do you have Intel stock? Are you in Intel? It was the same as today. It was the same as today. I went on a cruise for my honeymoon back in October, and everybody was asking, hey, what's NVIDIA stock today? What's NVIDIA stock price today? I was like, oh, this sounds interesting. But again, it doesn't mean you should sell NVIDIA. It means you need to understand that when you buy a stock, you're buying a piece of a business. You're buying a piece of future cash flow. If you don't pay the right price today, it doesn't matter if they hit every projection you hit. it could still be a bad investment if you pay too high a price, as we saw with Intel. Now, Intel's an extreme. Cisco hasn't had the fall recently that Intel has,
Right.
but it has the same issue where the all-time high was back in 2000. Its revenue and profit are several times greater, and yet the stock price is still lower for the exact same reason.
Yeah.
Mo, let's see this other article that you have.
So this other one is great. I love the title. Intel, Nvidia stock gets a rare sell call due to mounting questions. Now this one, it's Seaport Research. They say it is due to geopolitical issues. That one says it's not China. This one says it is China. But also this one's interesting. It says prospects are well understood and largely priced into the stock already. So
more than priced in the stock, if you ask me. So guys, I mean, let's pull Nvidia back up again. Look at their price of free cash flow, 46. 5 years, 130. But remember, their free cash flow skyrocketed in the last 5 years. So this is a little misleading. The question is this free cash flow sustainable? 72 billion last year versus 26 billion as an average for the last 5 years. Same with their earnings, very consistent. Guys, everything about this company is incredible. The question is this revenue growth continuing on? That's the question we have to ask ourselves, because that's what's going to determine if it's a decent price today or not. Or not even that, to determine the right price for it. Okay, so Mo, what's this Barron's article talking about selling Nvidia stock and why this analyst just warned investors to get out now?
Yeah, so he put the price target at $100 a share, and he basically said the spending that's going to be needed behind the scenes is going to cause Nvidia to not continue the growth path.
So first off,
stock growth path.
So it's very, very interesting and telling that an analyst is coming out and saying sell the largest company, the most hyped up company out there. That is very interesting in and of itself. Now, we've talked about this. Nvidia stock year to date is basically flat. A lot of fluctuations, right? You've got it's a company that's leading the hype. At one point, it got as low as what, $86 a share. So from January 7th at $153 a share down to 3 months later, $86 a share. Guys, can we just talk about that for a second? A $3.4 trillion company. Well, at the time, it was higher than that. Dropping 45% in a matter of 3 months. First off, markets are not rational. That's the first thing. Second thing is, NVIDIA is going to have to spend a lot of money.
Yeah.
One, it has a lot of money. It generates a lot of cash. My question on NVIDIA still isn't about that. It's about what does the future hold, as they were the first to market. If they weren't the first, they were the ones that really dominated the AI chip business.
Very early on.
But look at their margins. Their margins have absolutely skyrocketed. Guys, at one point, their margins were like in the 30% range. Their 5-year average is 45%. 1 year is 51%. Their gross margin here at 70%, it used to be in the 50s. So they have had huge margins. What do huge margins do? It tells other companies that make chips, hey, get into this business right now. You can make a lot of money. That's the concern, because if more people enter it, more mature companies enter the market, what's going to happen to prices? They're going to fall.
They're gonna fall.
Margins are going to
Competition,
contract.
yep.
Margins can't stay that high forever on a business like this, in my opinion. Could I be wrong? Absolutely.
It's interesting because we're talking about analyst reports here. These are the only guys with a sell rating on Nvidia.
Come on.
According to FactSet, and the average target price is $161.59. This guy's at $100 a share.
But even at $100 a share, guys, you're talking about a $3 trillion company plus selling for 46 times free cash flow. Even if they're able to sustain this and just keep growing cash flow consistently, let's see what analysts are thinking here for the analyst estimates. I mean, major earnings per share growth here, Mo. Look at this. 50% growth in the next year, 25, 17, slight decline, and then 14. They're going from $3 per share, according to analysts, to $7.16 in the next 5 years.
And I will say, even though you see that decline, 14% at that market cap, whatever that'll be, is insane.
It is a lot. I mean, analysts are thinking $300 billion in revenue. Guys, whenever it comes to these major hype companies, remember, these analysts have a bias here. They're sitting here and they're going to sit there and say, listen, we need to justify these high prices. Do I have concern over NVIDIA's slowing growth rate? Not because it's NVIDIA. Not because I have fear about NVIDIA's business. I just sit there and say, how does a $3 trillion company, if it's justifiably worth $3 trillion, continue to grow to justify a higher valuation? You know what this is like? This is like taking Barry Bonds in the late stages of his career. I'm not saying NVIDIA in the late stages. I'm just saying there with his best performance and saying, we're going to pay Barry Bonds like he's going to perform even better than today. You've got to sit there and pay a reasonable price for that potential. As this hype has gone up, as the stock has gone up 10x in the last, 2 years, you got to question, are you paying too much for that growth? Now, Jordan Klein, another analyst, has a different projection for NVIDIA. Mo, what you got there?
So this Jordan Klein, he's from Mizu Securities. So he shared his thoughts after the earnings report. And he said, I'm not saying that everyone's going to dump semis today, but many of the stocks rallied so much and the near-term risk reward is no longer favorable in his eyes, looking towards the middle of the year.
So first off,
So he's trading.
yes, exactly. That's exactly what I was getting into. And like, why is an analyst who you ask him, hey, are you a long-term investor? He would say yes.
100%.
Why is he talking about the short-term price movements? We have no idea what's going to happen in the short run. And he even sits there and says that he's focusing on $6 earnings per share. It's like, okay, even if they do crush that, look at Microsoft. Microsoft is a company that every single year their EPS went up from 2000 to 2010. And where did the stock price go? From a high of 52 down to a low of like 11 or 12. Who cares what EPS is doing in that regard? What matters is, are you paying a reasonable price? Now, Professor Oswath, who's a friend of the channel, he's called the Dean of Valuation, he talked about selling his Nvidia stake. His biggest thing is overvaluation, even though the fundamentals are incredibly awesome. You guys, you've got to remember that. If you have I'm going to say this till I'm blue in the face. If you have overvaluation, even if the fundamentals are getting better and better, if the fundamentals don't justify that overvaluation, and you're going to have problems at some point. In the short run, we have no idea. Look what's happened. Look at this. Look at Nvidia. In the last 1 month, it's up 19%. 19% in the last 1 month. That's incredible. So guys, just like what happened in the dot-com boom, the internet was young. The internet was so young. It had a lot of potential there. But overvaluation drove people to lose a lot of money. We've got to be able to look at any company, look at its valuation and its future prospects. Are we speculating on future prospects? Yes. But guys, that's exactly why I use Stock Analyzer. This is why we have the 3 levels here, because we don't know what the future is going to hold. And sometimes you're making very extreme differences of value of growth rates and margins. The younger the company, the harder it is. The more the company's entering a new market like AI, a younger market that we don't really understand very well, this is what makes it difficult. We sit here and look at this, and you look at our 8 pillars here, guys. It tells the story. So many check marks here. The questions are, and even these X's, I look at this going, this is 5-year numbers. 5-year PE and 5-year price of free cash flow. Guys, they're freaking earnings and cash flow is up 3x in the last year versus its last 5-year average. This is all out the window. It tells you a story. That story is, this is a solid company, very little debt. Look at this debt level. We want this long-term liability divided by free cash flow to be under 0.57. Remember, it's 5-year free cash flow. If you base it on last year's free cash flow, this 0.57 becomes 0.19. 0.19. They have no debt. They have 0 debt. This is absolutely a great company. Now, Mo, obviously on this channel, we talk about fundamentals, we talk about valuation, but there's other ways to make money. So what do the charts show on NVIDIA?
So the interesting thing about NVIDIA is if you look at this chart, these white, purple, blue, yellow lines, these are the moving averages. NVIDIA is over all of these major moving averages. So what does that mean? It's going to be very hard for NVIDIA to pull below these major moving averages. You can even see when it dipped here in April, it sprung right back up. These moving averages are kind of magnets. They just suck stocks right back up to them. But if we look over here on the long-term chart, and you just kind of draw a line across, you can see there's a very strong support level. So the guy that says it's going to be $100 a share, it could be $100 a share. It's going to be very, very difficult for it to get down to that level because it's a darling of the market. Everybody flocks to NVIDIA. And this strong level of support, it's like a steel-eyed beam in a building. It's just hard to break through that. You need a lot of energy to get through that level.
But once it does break through, what happens?
Once it gets through, if you come down here and look at these gaps, those gaps are pre-market moves. Once it hits those, it could fly down like a flying crowbar, falling off a building.
So on the recent market, when it fell to 86,
it fell fast.
It did fall. What was the support level there? Did it fall through a major support level?
It did. It fell through the support level we're at, but it just shows you, if you get through that support level, all those moving averages, it just goes.
And it plummets and
then maybe it's an opportunity if you think it's a good value or something. But you can it's also a way that you can play options. You can see, oh, I have a lot of support here. Maybe I'll sell puts below that level at
I gotcha.
staggered amounts.
I gotcha. Okay, well, that's interesting.
Yeah. So, Paul, we actually have a trading channel that's designated to charts. If you search my name, Mustafa Hussein, in YouTube, it is all about the charts. We do talk a lot about Nvidia. It's a great place to be. I invite you to come over, subscribe. You'll love the content.
And remember, charts, fundamentals, different things. I personally believe in both. I think I've seen people make a lot of money day trading. The question is, you have the discipline. You still need discipline no matter what you're doing, but it's another way to keep yourself busy while you wait for great companies to come to great prices based on fundamentals. Mo, let's pull up our history on Nvidia. What have we done in the past and see if we still agree with these assumptions. So I did a 10-year analysis recently. Now here's the hard part. I did 5, 12, and 19% revenue growth. These are, like I said, guys, huge differences here. Here's how different it is, guys. 5-year revenue growth for 10 years is 62% increase in revenue. 19% growth for 10 years is 5.69 times the revenue, which is 469% growth. These are very wide ranges, but that's what's hard about AI. We don't know what the future of AI is going to hold. Yeah. We don't know if other competitors are going to enter this market very strong.
That's the thing. When you put in 5, I'm like, okay, let's see how competition gets.
5 is super low.
It is, but let's say that there's mass competition.
And let's assume this revenue growth like this still stabilizes and doesn't go like this and then back up again.
Yeah, that's true.
That could still be 5% right there,
right,
with this happening along the way.
Yep.
There are so many ways in which this happens. Okay. Actually, you know what I'm going to do, Mo? I'm going to do 5, 10, and 15.
Okay.
Because I just feel like 19 is just so high. Profit margin. Now look at this. In the last 10 years. But remember, they've been driven a lot of these profit margins here, growth from the last. I did 27.5, 35, 42.5. I'm going to make this 30, 38, and 46.
Okay.
What do you think?
I think it's fair. It's a nice spread.
Now, some people would say, well, Paul, they've been crushing that lately. Again.
But it's been lately.
Yes.
You can't just go based off of lately.
Correct. Let's assume things even out, more people enter the market. Now, PE. Mo, what's the appropriate PE for a company like this when look at their returns on capital?
I mean, it's significantly increasing.
I put 18, 22, and 26.
If you said I was going to go higher, I would say fine.
Yeah.
Like, I think if you went 20, 24, 28,
let's do that.
Try that.
By the way, what we're doing here, guys, we're not trying to make the numbers better.
No.
What we're trying to do is sit there and say...
Trying to be realistic.
But the reason I went 18, 22, and 26 was if they don't do well, 18 still seems reasonable.
Right.
And if they crush it, 26 seems reasonable.
Right. If they do those high numbers, I would be like, I'll pay a 30 PE.
You know what? Fine. I'm going to go back to this. Because I still believe that this accounts for potentials. Now, finally, my desired return of 9%. This does not include margin of safety. You've got to remember that. You need a margin of safety or else just go buy a low-cost ETF. So for those of you who have our software, 9% here, you got to go higher. How much higher? That's up to you. It depends on how comfortable you feel with the company.
Yeah.
This is why we have people in our community talking about these companies to get more ideas of what's going on with them. So I hit the analyze button. It's going to give me 6 numbers here. Now, guys, Nvidia is an absolutely amazing company, but again, that does not mean you should blindly buy it at any price. All companies, you should never buy blindly. Valuation and understanding the business and its future matters. And if you're serious about building that kind of wealth, not just chasing the next hot stock, you need a system that works in any market. Now, back in April, when the market dropped and fear spiked, headlines went crazy and most investors froze. It was tariffs. It was all these other things, other noise out there. But while they panicked, as you saw in our videos, we were prepared. We talked about getting ready for the opportunities that this was giving us. Now, the question for you is, did you feel that you were ready? Did you feel that you understood when a stock was falling, why it was falling, or if it was an opportunity to buy? I've been there. Early on in my career, I was in the market with no plan. That was the .com hype era. I was chasing random tips, watching stock hype, hoping it all worked out. Guys, and when things went poorly, I was scared shitless. I have great stories about that. That isn't investing. That's gambling. This is exactly why Everything Money was built. We had the tools for you and for me, real strategy, real community. You'll get the stock analysis software that makes sense, that puts the story and the numbers together. And it also gives you access to thousands of disciplined investors who actually know what they're doing. Less guessing, less hype, data, strategy, clarity. Start your 7-day trial now. Hit the link in the description below. But a heads up, we don't know how long we're going to keep the trial open. And we don't want people who are coming in for quick tips and quick money. It will never work that way. You will be shoot out of the community. People will realize who you are and say, get out of here. But if you're ready to be a long-term, like-minded investor, now's the time to get in. So I hit the analyze button. Guys, I have a low price of 36, high price of 156, middle price of 77. To me, this is what I'm concerned about. You look at this and go 15% revenue growth the next 10 years. You might sit there and say, Paul, that's easy. But it has to do that just to get to a price today that makes sense where you can make an above average return.
Yeah, that's without a margin of safety.
That's without a margin of safety. That's what's concerning here. So guys, earlier this year, I picked my own magnificent seven stocks that I think will beat the market in the long run. If you're serious about finding value in this market, you have to watch this video. Not to go buy these 7 stocks, to understand the process of why I picked these 7. And guys, they're not hype stocks. These are companies with real solid fundamentals, strong balance sheets, and the kind of long-term upside relative to the price you're paying that gets every value investor excited. So go check it out and learn why they have great upside potential and avoid the overpriced junk out there. Click on this next video. Thank you for your time.